Thanks so much for coming out to this presentation on the first time home buyers playbook, where we're going to educate you and show you exactly how to go from maybe even $0 in savings to getting your down payment, getting approved for a mortgage, and then going out and finding that house of your dreams. All right, so we're just going to go over today's agenda. Now we're going to talk to you about housekeeping and the giveaway set up for you. Who are the financial game plan by Trevor, mortgage strategy and pre-approval from Mac, and then when it comes to buying a house from me. And then we'll talk about a success story and how to work with us. All right, so a little bit about who we are. Trevor?
So I'm a certified financial planner. I've been practicing for over 23 years. I know I look like I'm 23, but a little bit older than that. I'm a chartered life underwriter. You can ask me any advanced tax planning question you want between holding companies, trusts, and corporations. And I'm also a certified Kingdom advisor. I do incorporate biblical financial wisdom in my practice. And I'll be sharing today on how to create that down payment out of nothing in 90 days.
Good morning, everyone. I'm honored to be a part of this panel this morning. My name is Mac Phillips. I'm a mortgage professional right here in the GTA. I work with Canada's largest brokerage, Dominion Lending Centers. Just a few things about me. I've actually been in the industry now 6 years. I actually worked in hospitality prior to the pandemic, a very fortunate transition into finance. I've had a lot of success in the business in this time frame. I'm actually a platinum broker as of 2025, top 2% Canada-wide. I've had an opportunity to help well over 300 families now, and really have invested my time, my energy in your success around becoming a first-time homebuyer specialist. So really going to share some really key takeaways this morning. They're going to leave you hopefully learning something and feeling refreshed and motivated to become a first-time home buyer later this year.
And myself, I am a real estate agent, advisor, and salesperson. I've been in the industry 10 years as of next month, and I'm happy and grateful to be an award-winning realtor in the top 10% of all realtors. As we know, there's 70,000 of us, and it's a huge accomplishment for me. And in terms of how I got into real estate, I started with investing, and even prior to that, just educating myself, and everybody that I knew that had the ability to buy a house, I was telling to buy a house, even before I had my license. So it's just been a part of who I am for a long time. All right, let's get into the money.
So this part, I'm going to talk about where should your down payment live. So should it be a first-time home savers account, RRSP or TFSA? We'll talk about the tax benefits, how you're going to withdraw from those accounts, the limits, and some case scenarios for you as well. Next slide. So the first place you should probably have your down payment is a first-time home savers account. So I'm talking about your own money that you have saved up. The reason being is any money you put into a first-time home savers account is tax deductible, just like an RRSP. So if you put in $8,000 maximum limit per year, up to $40,000 lifetime, you would be able to deduct $8,000 off your taxable income. If you don't use it 1 year, you can carry it forward. It's only for first-time home buyers, or if you haven't owned a home in the last 4 to 5 years. So if you put into a first-time home savers account, you got 15 years to buy a home. So it's pretty generous. It's a really great program. If you use it to purchase your first home, you just fill out a form, you give me the purchase sale agreement, and I send you a form to sign, and you get your money. And then you just use that money as your down payment. It's tax-free. You don't have to buy it back. If you don't end up buying a home in 15 years or before that, you can transfer it to an RRSP. There's no impact on your RRSP deduction room. The other thing you could do is you could withdraw it as cash. If you do that, that's taxable because you receive the tax deduction up front. And then you can always transfer it to another FHSA if you want to consolidate. One more thing with the FHSA, you can pretty much invest in anything you want. So if you know you're not going to buy a home in a while, you may want to invest it conservatively, balanced. If long time, maybe a little bit more aggressive if you got more time to wait. But if you're going to buy a home soon, you probably shouldn't invest it. Just put it in like high interest. The next thing you could do once you max out your first-time home savers account is utilize the first-time home buyers plan. So this is using your RRSP. You can borrow up to $60,000 from your RRSP tax-free as a loan, and there's no tax when you withdraw. So potentially up to $120,000 per couple. Now, the rules are if you withdraw and take this loan from them, you got to repay it starting the second year. That second year can be delayed to the 5th year. And what you do is you repay 1/15 of that loan each year by buying RRSP at any institution. If you don't buy RRSPs that year, that 1/15, it just gets added to your income. So it's not necessary that you buy it back, but just be aware that there may be some tax consequences. What you could do is you could take that RRSP contribution room, that deduction, and you can carry it forward. against years that you're not going to buy back RSPs if you don't want to buy back the RSP. So if you buy an RSP, it's got to be there for at least 90 days, right? So if you're going to buy within 90 days, you can't do this, unfortunately. So I do encourage you, once you max out your FHSA, if you have an employer and they match your contribution, do that. It's free money. As soon as the employer puts money in RSP, it's yours, it's vested. You can take it out, do whatever you want with it. The withdrawal has to happen within 30 days of closing. So you got to have the money sit there for 90 days and you have to withdraw it within 30 days of closing. And that's the same with the FHSA. The FHSA doesn't have a 90-day holding period. So I had a client the other day tell me they're going to close next month. And I said, hey, did you buy any more FHSA? And they told me no. So I had them contribute some money and they're just going to pull it out right away. And again, you can't use this again if you've owned a home in the last 5 years. So here's some examples. One thing you could do, and a lot of people don't realize this, is you could take an RSP loan. Financial institutions are not allowed to put a lien against your RSP because it's a retirement account. So for that reason, you should save your own RSP room, use up your FHSA, and then use other people's money to fund your RSP if it makes sense. And I'm going to show you. So here's an example of a $20,000 RSP loan. It costs about $238, roughly at 7.7%. So the way you should do this is you should contact someone like me or Mac to get started. And I will probably send you to Mac to get a pre-approval done with this RSP loan considered in the pre-approval. We want to make sure you can still qualify for the house and the RSP loan at the same time. This strategy of borrowing money to fund your RSP doesn't work for everybody. You have to have a pretty good cash flow to float both the mortgage and the RSP loan. The RSP loan can be stretched out over 10 years max. It can be shorter too, and it can be paid back anytime. The benefit of this is you put a larger down payment. When you buy a home and you don't put down 20%, the bank will force you to buy the CMHC insurance that covers them. In fact, I've actually had clients get foreclosed on their home. CMHC pays the bank and turn around and they'll go after you for the money. So you're paying for insurance upfront load to your mortgage, and that can cost anywhere from $10,000, $20,000, $30,000 depending on how much your down payment is. So if you can put down 20%, this is a program that will help you do that. So there's 20,000. The next one is 40,000. So 40,000 will cost you $478 per month. So again, you have to be able to float that and also carry your mortgage and qualify for all of it. So again, we'll send you to get a pre-approval. And finally, 60,000 maximum. If you already don't have RSPs or haven't done that with your employer, you can max it out. It's about $718 per month. Okay? So what you would do is probably contact me first. I will run a budget with you. I'll do cash flow planning. Because I'm working with Odane and Mac, I won't charge for the financial planning. The house is probably going to be your largest purchase in your life. You should probably have a plan for it. And then I will also help you create something called a mock mortgage. So I'll look at your cash flow. And if your future mortgage is going to be $3,000 per month, plus utilities, property taxes, and all, I'll get you to save that amount minus your current rent and debt expenses to simulate a future mortgage. And basically, you get the RSP loan if you can qualify for it. And you just leave it there for 90 days. After 90 days is up and you have your purchase sale agreement, we get that filled out with a form and you get your money and then you can make your down payment. So here's an example of a couple making $52,000, $85,000 per year. They only had $10,000 in down payment and they needed to increase their down payment because they couldn't afford anything. So what they did is they structured an RSP loan of $30,000. It creates a large cash back because, as you know, you put money into an RSP, you can deduct that money for tax purposes, or you can carry it forward. And you can take that cash back and you can use that to repay the RSP loan or pay closing costs and whatnot. So this couple was able to purchase a $600,000 home doing that. So typically, again, the sequence in which you should do this is your own money should go into a first-time home savers account, $8,000 per year. If you don't have one open, I encourage you to open one up sooner than later, because if you don't, CRA doesn't know it's open and you can't carry forward last year's contribution room that you didn't use. You got 15 years to buy a home, so very long time. RSP, you get a tax deduction just like the FHSA, but when you withdraw from it under the first-time home buyer's loan, you're supposed to buy it back. Otherwise, that $115 gets taxed to your income. And we can do an RSP loan to fund your RSP. So you don't necessarily have to use your own money to fund an RSP. You may want to save that for the FHSA instead. And then once you've maximized the FHSA and the RSP, you may want to utilize the TFSA for tax-free growth. Okay, again, if you're going to buy a home very soon, you may not want to go into aggressive investments. You may just want to stick to high interest just to be safe.
Awesome. Before we jump into mortgages, does anybody have any questions for Trevor regarding the last few minutes of slides? I know I have one question, so why does anybody jump in and see if we need to tackle that right away?
Yes. Somebody says, when you say loan, is there an institute that will loan you money for an RSP? Then in 90 days, you can. So if you contact me, I have several lenders, B2B Bank, Industrial Alliance, different institutions that will lend you money. I typically pick the company that has lower interest rate for you, and then I'll just put it into account. If you're gonna buy a house soon, I'll just stick it in high interest, and you give me the purchase sale agreement, and we'll withdraw it after 90 days. And there's your down payment.
Fantastic. I've got a question for you, Trevor. So let's say that we connect with someone that's on this call today who wants to take advantage of this. How much time do we have left to take advantage of 2025 contribution room so that we can action their purchase during 2026?
Oh, you don't have much time. You have until Monday. You got like 2 days. So it's probably not going to work for an RSP loan. But if you want to do your own deposit with your own money, that can be done. Contact me directly. I can push it through for Monday.
So they'll still be able to use the RRSP loan. They just won't get the cash back credits associated with the rebates from this tax season. They'll get it next tax season, right?
2026, precisely.
Okay. So it's still usable. It's just you won't get back that marginal tax rate. Awesome. Does anybody else have any questions? No? Awesome. So it's mortgage time, everybody. So let's go into where the market is right now and some of the travesty we've come out of. So the vast majority of people who are homeowners, they went through 5, 6, even 7% interest rates over the last 5 years. Everyone on this call is actually fortunate to have puddle jumped over that market of interest rates, where right now, for you folks to purchase a home, you're looking at anywhere between 3.5 and 3.7, 3.8% for a fixed and a variable interest rate. So if anyone has a short-term memory, that's actually where we were before the pandemic started. So it was a total reset. So if we think of a balanced interest rate market, lenders right now don't have the same volume that they did during the pandemic or prior. As we know, the market has softened and there's less purchasing taking place. So lenders themselves have weakened and laxed the rules around qualification. They've created additional incentives like cashback. They'll give you $5,000 to $6,000 cash back just to close a home with them because they'll pay for your legal fees and otherwise. So if you're thinking about a first-time home buyer, whether or not the rates are where we want them and whether or not now is a good time to purchase, I think if you're waiting for the Globe and Mail to tell you it's the time to buy, you've missed the opportunity. What we've noticed and what Odane could probably speak to as well is that throughout the year, there's 2 lulls in the market where there's a ripe opportunity to buy during the winter and the last month of the summer. So you're in that right now. Doesn't mean you need to move in the winter, but beginning to put boots on the ground could save you tons of money if you begin to put things in motion over the next 30 days. You know, this is something that we've actually spoken to many clients about, and we found it required additional clarity, is that often folks think they have to go to their bank because mortgage brokers cost money. It's simply not the case. We are 100% for free. We actually get paid by the bank, 100% commission. So our success and your success are tied at the hip. To give you an understanding of what lenders that we recommend right now, Bank of Montreal, TD Bank, Scotiabank, and National Bank is actually going to be coming into the broker channel very soon. And for anyone who knows credit unions, Meridian has some of the lowest and best interest rates in the market. And we also work with business for self lenders. We have a client that may benefit from those kind of strategies, and lenders like Equitable Bank, where they're not tax necessarily heavy, they're more cash flow apparent. So we can talk about that further as we chat. So I think there's a lot of options when choosing your mortgage solution, whether it's your mortgage broker, the bank that you've worked with, maybe the recommendation from parents. I think it's important to know where we add in particular value. One of the pitfalls or almost bottlenecks that I've always been given feedback in that exists in the industry is mortgage brokers are usually a one-man army. It means when they get busy, they're hard to reach and they can't produce with efficiency. I run a team of 3. You'll meet my team if we look to have the opportunity to partner together. We have the efficiency and the ability to manage volume and to ensure that the customer experience doesn't slide after that initial first call. Because we have the ability to stay in touch, add value, and actually look to modify and improve cash flow even after the mortgage closes, my team and I have one of the highest retention rates in the industry and actually the highest in the brokers that I work with. Because we provide additional rates, and because we provide additional volume, we actually get better rates for you as our clients. So Scotiabank, TD, they actually provide us preferential interest rates lower than what you can get if you were to walk in and lower than the mortgage broker next door. And because of that, they provide us additional promotions to allow us the ability to best serve you and your family. And lastly, You want to make sure that the person that you work with is fully invested in their career, not a part-time mortgage broker, not an unlicensed customer service person at your local bank. Keep in mind, who you talk with at your bank is not a licensed professional that have the same education as the teller. We hold professional licenses, and I'm actually the top 2% of mortgage brokers in Canada as of today. Let's talk a little bit about your pre-approval. So the first thing that we need to understand, and why Trevor is so key in this, is because you don't know how much of an RRSP loan you need and how much you need to continue to save until you have that financial roadmap. So it starts with a 10 or 15-minute conversation. We're going to do a pre-qualification, make sure you understand exactly what you need to get to, and make sure that you understand exactly where you are so your savings goal is crystal clear. The minimum down payment, essentially for a first-time home buyer or any owner-occupied buyer rather, $500,000 or less as a purchase price. You need to have 5% or $25,000. And then between 500,000 and $1 million, we need 10% of the difference. So for that family who was looking to purchase at 600,000, they need $35,000 for a down payment. So depending on what your contribution limits are, that can be achieved in as little as 90 days. And the last thing that I want to touch on regarding new rules is that there are new incentives around pre-construction and new builds. There's actually a GST rebate up to $50,000 that gets applied to your closing costs at closing. So Odane is a pre-construction specialist. If you're thinking about getting into something with a long-term closing, perhaps a new project or city you want to move into, those new rules can be a great incentive to help cash flow. Okay. The thing to keep in mind is that for income, we have the ability to support all income types. So there was a question prior from a client or Gunit regarding if I'm self-employed and I want to be able to use cash flow in my business to qualify, how do I do that? So the first qualification you have to have is 2 years in business, either 2 years as a sole proprietor or 2 years incorporated. Then what we do is we track back the last 12 months of business activity and we look at gross cash flow. Then we do a very rough justice expense report. The net cash flow after those liabilities are considered is how much we use to help you qualify. So notice of assessments, we don't use them, don't want them, don't ask for them. We just look at your bank statements for the last 12 months. Okay. The last thing we want to talk about is the pre-approval. It starts with a discovery call. We have a strategy session about different lenders. We hold the best and lowest rate that's in the market for you, and then you're out with Odane shopping for a home. So I think this is helpful to touch on as well. Even though we know we're in a buyer's market and it's a saturated market of listings available, the right homes, the homes that are the best in the market, are still selling quickly, and we're still seeing bidding wars on those good properties. So condos with large outdoor spaces are still selling fast, and the right homes are still selling fast as well. So what you want to make sure is, A, are we actually in this fight with the right team who can help me win this home? Nothing worse than spending time shopping through a busy market, finding a home you fall in love with, and you miss out on your offer. We have the highest approval ratings, and as well, we can assist you with strategies to help you set your apart from the crowd to help you get your offer accepted. And we can talk about that on our discovery call together. Is actually the Arbor Program. Has anyone heard of the Arbor Program, guys, where you can actually build your down payment from 5 to 20%. So if anyone already has that 5% down and they don't need Trevor's RRSP loan, there is additional strategies that can help build you from 5 all the way up to 20%, which have about a 25% increase in your borrowing power and purchase price. That's another product that's very successful in the market today.
All right, so this is just a graph of where the market is today. And just to give you a high level overview, if you can see the shark fin on the left-hand side, that is the top of the market. That is February of 2022. Prices on average were over 1.3 million. And you can start to see where the prices come down, where the red dots start to come lower, is where the blue dots, which is the Bank of Canada overnight interest rate, start to increase. So they started at 0.25% and they went all the way up at their highest to 5%. In the meantime, where you see a little fluctuations where they started to hold the rates. So right in this here, they held the rates, prices held steady instead of continuing to go lower. But when the interest rates creeped up again, prices started to drop again. And when they held the rates, as you can see over this duration of time, the prices, the red dots, started to increase. But then the high prices have held fairly steady over time. And we expected the prices to increase when we saw the rates decreasing, but they have not. And in fact, last year we were dealt a blow with the Donald Trump tariff situation, and prices are starting to come down a little bit further. Overall, this is the most recent update in terms of stats in the GTA. I didn't want to get too specific because we're all probably thinking about purchasing in different areas. So you can see the average price, and you've probably seen the headline, has under $1 million for the first time in 4 or 5 years. So our average price is $973,289. As alluded earlier, because of the snow situation and also because of the market, total sales have dropped 19% compared to last year, January, and we only had a total of 3,082 sales. But the big number here to look at is this one in the red, 5.83 months of inventory. Now that means that if no homes were to be put onto the market, no new homes, it would take 5.83 months to sell all of the properties. So what that means is that in a balanced market, we're looking at about 3 to 4 months. In a seller's market, we're looking at about 1 to 2 months of inventory. Now that we're almost pushing 6, this is buyer market territory. So it's an opportune time for you guys to make a move. Just a little bit about what's happening in terms of real estate agents. There are over in between 70 and 73,000 agents right now in the GTA, and 35,000 of them have only done one deal or none. So the majority of the agents that are doing the deals are in the top 10%. And as you can see, 90% of the transactions are completed by the top 10% agents. And as I said earlier, I am a top percent agent, and I can definitely help you get to the finish line. Now, before we start viewing homes, you can see back there in the background, we got to slow down. If you have not already spoken to Mac or Trevor to get your financing and your down payment in place, then that's where we would start. We'd sit down, we'd discover, okay, you don't have these things in place. Go talk to Mac, go talk to Trevor first, and then we'll discuss what you're looking for. How big is your family? How many bedrooms, bathrooms do you need? Do you have kids? Do you want to be in a particular school district? All of those things have to be discovered first before we can actually go out on the streets and start looking at homes. Once we get those things in order, the financing and the down payment, and we start looking at homes, when you find the one that of your dreams, we got to make an offer. Only way we're going to get the house, or only way we have a chance to get the house. Now, the main components of an offer are, one, the price, probably the biggest one, the closing date, the deposit, and the conditions. Now, the price, we don't just come up with the number out of thin air. We have to do a comparative market analysis, or a CMA, to discover what other homes similar in the neighborhood have been selling for. And we don't want to go above that price because, as Matt can tell you, we will have appraisal issues when it comes time to get the mortgage. When it comes to closing date, there's 2 dates to consider. The date that you want to move in and the date that the seller wants to move out. Sometimes they can be in alignment, sometimes they're not. And that is an opportunity to negotiate for a better price if they don't match, and we're willing to give them the date that they're looking for. When it comes to the deposit, typically on a purchase these days, we're looking at about 5% of the purchase price, and the deposit is different from the down payment, and I'll get to that next. And then conditions. The conditions in the offer is the way that we protect your investment. We don't want to go in firm and say we're going to buy this house for sure. The conditions is a way that we protect you in terms of the house has to be in good working order or good condition, unless you're a builder or you're looking to tear down the house and rebuild from fresh. We want to make sure that your financing is in place, and if it's a condo, we have to do a status certificate review. Lawyer would do that actually. So the difference between a down payment and the deposit, Matt touched on what a down payment is. What a deposit is the money that shows that we're actually serious about purchasing this home. So the deposit has to be essentially given to the listing brokerage within 24 hours of an accepted offer. So when we do make an offer, these are the conditions to consider. Again, the inspection, that's where we essentially hire a home inspector to lift open the hood and make sure that everything is operating properly. So we're looking at the roof, or they are looking at the roof and an AC. They're looking at the structure of the building. They're looking at the plumbing, the electrical, the major things that will cost a lot of money if there was a breakdown after you purchased the home. The financing is where we take the offer, we take the listing, and we send it to Mac. Mac reviews it to make sure that the numbers align with what your pre-approval. And the status certificate review is where the lawyer will look at what's called a status certificate. This is everything that about a condominium building or a townhouse complex, where there's the rules of the condo corporation, and there's also the financing, how every unit owner has to pay towards their maintenance fees, how much is put away in the reserve fund. And the reserve fund is that essentially they take a portion of your maintenance fee to put into this fund. So if anything happens major, like for example, the roof goes, and imagine this is a condominium building, so it's going to be an expensive repair. If the roof goes, if the plumbing, something happens to the plumbing, if something happens to the heating and ventilation in a condo, you would like to have some money there to pay for those things. If not, we're looking at something called a special assessment, where they ask every individual owner of the condo to pay some money. And that can be somewhere low in the $500 range, and it can be as high as $10,000. So having this status certificate reviewed by a lawyer is of utmost importance, because they will protect you and let you know if this condo is in trouble financially or if it's not. Now, when your offer gets accepted, we've gone over the conditional period. All we have to do is set up a time to lawyer and close. These are some things to consider: land transfer tax, and that's on a sliding scale. The lawyer fee, which is anywhere between $1,000 and $2,500. The appraisal fee, which Matt can speak about, and the inspection fee for the home, the property inspector. That's anywhere in the $400 to $650 range. Now, this is just a depiction of how much your property land transfer taxes are. And in the city of Toronto, there are two land transfer taxes. There are the provincial ones, as you can see here, and then here are the city of Toronto. So you're paying double land transfer tax, essentially. So if you're buying in Durham region, York region, Peel region, you would only pay what's in this column here where it says provincial. If you're buying in the city of Toronto, you would be paying in this green column, the total. Now, as first-time home buyers, there are rebates for you. See if I have that afterwards. But the mistakes to avoid: essentially not speaking to Mac early in the process, underestimating your closing costs, so speaking to Trevor and having everything in order financially, skipping the home inspection. Now, that is something that you should not do unless you are a builder or you're qualified to evaluate a property on your own. It's to the point where I would actually have to ask you to sign a waiver if you wanted to forego this, because I have that much confidence that having a home inspector will protect your interests, and then not having your deposit funds ready. So a lot of us have accounts and I have a Tangerine account, I have a PC Financial account. Those accounts are good in terms of saving on fees, but when it comes to accessing your money, it is strenuous. It takes days, and as I mentioned, we have to have that deposit in within 24 hours after the agreement gets accepted. So you want to make sure that your funds are somewhere that you can access them fast. Also, if you have GICs or investments in stock market, you want to make sure that you have some liquid so that you can make your deposit. So the first time buyer perks, Trevor talks about these: the first home savings account and the home buyer's plan for your RRSP. Also, there's a there's a land transfer tax rebate. In total, I believe it's $8,745, somewhere around there. You get a rebate from the city of Toronto, and you also get a rebate from the government of Ontario. This is just a live example that I pulled from the MLS, where it shows this home just sold this month in February for $495,000. It's a Young and Shepherd. It's connected to the subway line. Great value. Now, if you go back to 2019, it also sold in February, and it sold for more than it sold now. It sold for $505,000 back then. So essentially, prime properties today, you're actually going back in time and taking advantage of lower prices. So if you ever said, I wish I bought 5 years ago, this is pretty much the time. We're going back in a time machine. After this webinar, I will be sending out a free credit tips guide, one pager here, as you can see. I'm not sure if you guys have great credit or if you need some work, but if you do, this is perfect. And if you know somebody that does need some work, you could forward it to them. But yeah, essentially, that's what we got for you. Would love to connect with you. Depending on where you are in the process, you can reach out to Mac if you need to get pre-approved for a mortgage, Trevor if you need financing, and if you're already ready, you can reach out directly to me. This is a reminder of the tickets that we have for anybody that participates in this contest. Go to the QR code, answer those questions, follow all three of us, Mac at Mac Mortgage Broker, Trevor at Legacy_Financial, and myself at Odane Harding Realtor. And yeah, I want to open it up for any questions that you might have.
I was mentioned too that there's a first-time home buyer credit, tax credit. It's worth about $10,000 federal credit that you can claim on your taxes when you buy your first home as well.
Yes. So that's a 10%, 10,000, correct? So you might receive 1,500 in cash value.
Yeah, it's a tax credit, so you don't get actual cash. It's only if you owe money, it will reduce your taxes.
Any questions, guys? You can either ask them in the chat or you can unmute yourself.
What's the max on the RRSP? So the RRSP is really based on your room. It's based on 18% of last year's income that you made up to a certain maximum of about 25,000 each year, minus pension adjustments. So you would have to log into CRA and see how much RSP room you have, or look at your notice of assessment and tell me how much room you have. So that's a good point. You do have enough room in order to contribute to an RRSP. So FHSA, everybody gets 8,000, but you don't get to carry forward room unless you open up the FHSA. So I would encourage you to open it up sooner than later. And you put a nominal amount in it and fund it later. There was a quick question of variable mortgages versus fixed. I kind of answered in the chat. I don't know, Mac, if you want to elaborate on that some more.
Yeah, for sure, I can do. I think you did a really good example of exactly, fixed. However, just to layer it one step further, there's actually two variable offerings. There's one that offers some of the benefits and the peace of mind of a fixed, whereas there's a lot less fluctuation in the payment. There can be a fluctuation in the payment, but it's only under unique scenarios, like during the pandemic. There were some shifts in the fixed variable, if you will, probably the easiest way to describe it. But then there's another variable that is fully adjustable, that as the Bank of Canada make changes, your payment. So as we strategize, what's better as an investor or a homeowner, we can talk about the pros and cons of each. Essentially, there's three mortgages, if you think of it that way. Two variables and one fixed. Yeah. Okay.
Kevin,
I'm not able to.
we can't.
You're muted, Kevin. Yeah, unmute yourself. Still can't hear you.
Yeah. Maybe put it in the chat, Kevin, if you'd like as well. Okay, there we go.
What was the other financial product?
Yeah, no, I had one. Thanks for asking. I wanted to ask about one of the questions about needs. Can you hear me? Oh, okay, hold on a second.
Yep.
Yes, I can hear.
Is it good? Can you hear me?
Yeah, you had a question about, did you say leads or?
Can you hear me now? Sorry.
Yeah,
Yes.
we
If
can
somebody
hear
asks me a question, that's fine.
Yeah, go for
Yeah, we
it.
can hear you.
Go for it.
Okay, perfect. No, I just had a question in regards to one of the needs near the end regarding sure you have your payment, and depending on the banking of what you have to make sure it was liquidated. Just a clarification. I saw it on the slide, but it kind of went really at that moment there. And I know
Yes,
there's a
sir.
recording, but I just wanted to confirm that.
Yes, for sure. So you see the house that you like, and we put in the offer, and the seller accepts it. We have 24 hours to put in the deposit to their brokerage. So that means 20,000, 30,000, whatever it may be. Now, if your funds are wrapped up in a Tangerine account, Tangerine usually takes 2 days to get you the cash they're requesting in terms of a bank draft. So if you don't have it, the seller's going to panic or the seller or the agent is going to panic more so. And they're going to ask where this deposit is. They're going to just think that we might flake on them, because people do put in offers and then they change their mind after the fact and they don't have the deposit.
That makes sense. Yeah.
Yeah. So their funds in Tangerine or Financial or Simply. And sometimes it could be in a stock account where it might take a while to process the order if you're trying to sell it to get the cash for the deposit. So we just let you know in advance to have funds prepared if we're boots on the ground and we're looking at properties.
Fair enough. Okay. I appreciate
sure.
that. Thank you.
Sorry, let me just layer onto that just one step further. What I noticed is that a lot of folks are so aggressive in saving in the RRSP that when it comes time to make a home, all of their funds are locked into the RRSP. And what you need to do is you need to have 5% often to be able to be treated seriously. You need to have 5% liquidity. So the kind of catch-22 is that the RRSP is only withdrawable, or you can only get the funds out once you prove to that company you've made a purchase with your agreement of purchase in hand. Funds take 5 to 7 business days to hit your account. So once you've maxed out the RRSP, then obviously save in cash, or the other option is go to the bank and get an unsecured line of credit. You can use the unsecured line of credit to float the deposit and then just pay it back once the RRSP hits your account. I couldn't tell you how often I speak to a family and they're not prepared for the deposit, and now we have to do additional things to make that ready.
Okay,
Yeah.
I appreciate you answering my question, and yeah, thank you so much.
You're welcome. There was a question regarding the last finance strategy I talked about before I was done. So what that is, guys, is and gals, is actually a program that is GTA focused. So Durham to Halton up to Simcoe, but then they all have also included Kitchener, Guelph, Waterloo, and London. So what it is that if you are looking to purchase a new home and that home is going to be your principal residence, a lot of folks have great income, good, like they've got the 5%, but the pre-approval number doesn't meet what they need for their family dynamic. Maybe they want to live in a detached home, but now they're qualified for a condo and they don't have the ability to step up and wait years to move up the equity. So what we can do is we actually have another company where we can inject funds into your down payment. As much as 15% of the purchase price we can give you to invest in your purchase. So the first thing that comes to mind is this it's not a loan? What's it going to cost me? Nothing. What are my monthly payments? Nothing. What's the interest rate? It's not a loan. So if you're thinking that this is something that you learn more about, reach out and I'll happily educate you on how that works.
Question here, Mac. I think it's regarding the program. So you own part of the home until you sell.
What it is that you have to think of the product like it's in your home, and that as the home appreciates in value, when the home is sold, you will both benefit from the appreciated value of the property. So you can stay in the property for as long as 30 years. It doesn't have to be a fast flip. So you're in the home that many years. When you sell it, there's then a division of the equity in the property and the gains in the property since you took ownership to the time of sale. So it's a free investment in your property. Yep.
Thanks for the question, Jermaine.
Yep. Easy example that I could lend to that is, let's say you were to buy $1 million house. Traditionally, you had to have 20% down. This is when at that lower price point. Now you have to go to 1.5. But regardless, let's say you want to buy $1 million house, you need 20% down. That's $200,000. Traditionally, let's say that you put down 10% and the investor puts down 10%, or this company puts down 10%. It isn't a human being. Then let's say that $1 million home goes from 1.1, $100,000 of appreciation. You would get 50, they would get 50. So that's how that works.
So when I started in real estate, I belonged to this club called the Real Estate Investment Network. And one of the big things they used to always teach us was that percent of something is better than 100% of nothing. So you can think of this program as something like that, where if you can't get into the home that you actually want without this program, you're probably not going to buy it. And then you're not building equity towards anything. But with the program, you still will own and you'll still get your what you deserve in terms of equity. Sheree Palmer has her hand up. I think it's a lady.
If you want to unmute yourself.
Sheree, you can either leave a question in the chat or you can unmute yourself and ask a question. I'm trying to unmute you, but it says I cannot unmute someone.
Sorry. Question. What if you wait until the end at the selling to repay this? What if you want to repay that at say 5 years down the line of whatever it's worth that time, instead of waiting another 15 years to repay this deposit, or you won't call it a loan?
Yeah, so there's an investment in your home that you can repay at any time if you choose to. If you can a cash or an inheritance of some sort and you have access to capital, by all means, please repay that. I'll tell you the way that we've structured it, just so you can kind of wrap your around where the real value is. So the first is that if you're an investor, for example, Okay. If you're an investor, for example, and you say you have $50,000, where would you best see that equity or that $50,000 grow? Is it more safe to grow in a portfolio with Trevor? Or what some people are thinking of, let's treat my own home like an investment, and my down payment essentially is growing in this new vehicle. And that vehicle just happens to be my home. The idea is that you invest, you allow your equity to grow, you allow that capital to grow. And right now in the GTA, if you invest for 10 years, it's almost certain that that investment doubles. And then you pull your cash back out. Now you don't need any more support because you're available to you. And then you rebuy a new home using only your funds, and you've left the investment by the wayside. As someone who's looking to essentially just create more net worth to get into the market, that's the safest and savviest way that homeowners are using it, treating their own home as an investment vehicle to see that deposit and down payment grow. Okay, I hope that helps.
Yes, it did. Thank you.
You're welcome.
Just expanding on the investment part, you know, when you home, you're putting into your equity. So, you know, it's more of your payment will be going towards your equity, you'll be saving. And then eventually when you sell the home, it will be tax-free, because first home or principal residence is one of the only things that's tax-free in Canada besides a TFSA, FHSA, and life insurance. So you probably want to buy a home long term. And it's pretty cold in Canada, so you need somewhere to live.
Well said. Awesome. Okay, well, that was quickly. I really appreciate everyone joining us on this Saturday morning. Is there any other final questions before we head off and enjoy our day? Justin? Awesome. Thank you for the feedback, Justin. Really, really appreciate it. Beautiful. Okay. Beautiful.
Thank you. You as well. Have fun. The sun is shining.
All right. Thanks a lot, folks.
Okay,
All right.
thanks for showing up. Okay, take care.